Excellent. Well, welcome back to a new episode of the No Bonds Cast. My name is Ben Beck. I'm here with Garrett Murphy, who I'm going to introduce in a moment here. But I wanted to welcome you now that tax season is over. We thought it would be a great idea to get together with Garrett and introduce him as the new tax director at Beck Bode. It's been something that, as you know, that we've been planning for quite some time at Beck Bode to bring tax services in planning and preparation under one roof at Beck Bode. Something we've been thinking about for a long time and knew that it was going to be tremendously additive to the client experience. And just so excited now that tax season is over. And by the way, you look really well rested having gone through your first tax season here. But wanted to make a formal introduction and then talk about some things that you observed in your first season, even though taxes are not new to you, obviously, but at Beck Bode, some of the things that you observed working with clients. I think it's always a good thing to talk about some things that that maybe some people don't know about best practices and what people should be looking out for and how they can benefit their overall financial situations with respect to planning and the ways to go about preparation. But first, before we get into all that, I wanted to give you an opportunity just to say hello to everybody. As I said, they probably, a lot of folks watching probably haven't met you yet, but I'm really excited to have you here and have this conversation with you.
Yeah, thank you, Ben, and nice to meet everybody who has not worked with me so far. My name is Garrett Murphy. I live up in Wakefield, Mass, with my wife and 3 young children. Thank you for the compliment, Ben. Mm-hmm. This was a very smooth tax season. Home life, we're getting there.
As a father of 4 kids, I can attest that it's like the markets. The home life can be very volatile, up and down. But yes. Garrett here is crushing it for sure. But so you came and joined us in October of last year.
Correct, yes.
And you came on as the Director of Tax Services here. Mm-hmm. Tell me a little bit about your background, like where were you before and what kind of things you were doing?
Sure, yeah, so I have about 13 years of tax experience. Mm-hmm. Started at a few different smaller regional CPA firms in the greater Boston area. Moved to a few different real estate firms that do more national commercial real estate, and then came back to tax somewhere where my passion really lies is working with smaller businesses in 1040s doing individual returns.
Gotcha. And one of the things here, as is we have a lot of small business owners as clients, folks that have a interest, but also the need to have somebody that is not only doing their taxes, but understands their overall financial situation, right?
Yeah. And one of the more rewarding aspects of my job is sort of taking a look at the big picture. Someone who's just starting a business or trying to ramp up their business, they have a lot of questions. There's a lot of opportunity for structuring certain ways just to kind of wrap everything together so our clients are feeling confident and comfortable with how everything lies within their business and their tax picture. So A, they can really focus on what they do best, and B, there's no surprises, everything is structured correctly, and things are functioning smoothly.
Yeah, it's great that you brought that up too, and I know just in my 20 plus years of working with families and a lot of business owners with respect to the wealth management side, that's a piece that I feel like was always missing in terms of coordinating all of the important things in your wealth management picture and your financial picture under one roof. So I'm really excited to get into some of these things with you today. Certainly, we do put these No Bonds Cast, the Beck Bode No Bonds Cast out as educational pieces. That's a big part of what we do. We want to make sure folks have a resource, a trusted resource like us to understand, hey, what are some of the things that are going on underneath the hood, and certainly to be able to learn about some of the things that they might not know about that could be beneficial to their financial lives. And so Like I said, I'm really excited to talk to you about some of these things. Not a lecture, but just a conversation about some of the things that are important to us and our clients. Let's jump into it if you're good with it.
Sure.
When people have now filed, what is one thing you wish they have looked at before they hit the submit button?
Yeah, I think one thing that's really important this time of year, right after everybody is filed, is to take a high-level look at your tax return. And it can be very different for different types of individuals, whether you're a business owner, self-employed, you're retired, or you work a W-2. It's, I think, so important just to take that high-level look to understand what is driving your tax due. Everybody come April, depending on if you have a refund or if you have a big balance that you might owe, that all gets formulated throughout the year, and it can be dependent on what you have withheld. It could be dependent on some of the things in your business. Maybe last year you had large investments that you don't have this year. And a lot of it too kind of gets spun from just sort of like having a conversation with your tax advisor. But having that idea formulated will really help you in the next year. Just have some sort of understanding of what the bill might be next year, or a refund, or some different advantages or strategies that you might want to take throughout the year just to soften the blow.
So one of the things that comes to mind is, like, you talk about that, is something like paying quarterly estimates, right?
Right.
Is that something, so in as you know, working closely with our clients, again, athletes, business owners, and so on, one of the questions that comes up, when, I got all this tax due, or maybe there's even penalties for underpayment of tax. And so when you talk about, hey, taking a high level look at the return, having a conversation with you or their tax advisor, is that, hey, how do I then best eliminate, those types of things that are kind of easy things to check off when it's all said and done, but if they don't know about them, right, and if they don't take that high level look at their return, like, hey, what's driving the reason? Okay, I know that I can't avoid in full paying tax, but if there are these little things along the way that I can improve my situation, pay less tax, maybe get a refund or whatever it may be, those are good things to do. So you're saying that one of the big things is, go through that tax return once you file it.
Yeah, take a look at it and just, estimate payments are a huge piece of it. Withholdings are a huge piece of it if you're a W-2 employee. And just another big aspect of this too is taking a look at your effective tax rate. So a lot of people fixate on what's the refund, how much do I owe, which is certainly a huge factor. But if you take a look at the return, what you can do is you can take a look at the total tax paid throughout the year, your total tax, divide that by your adjusted gross income, and that's going to give you your tax rate. So that percentage, whatever it may be, is going to really kind of drive sort of what your withholding is, how many estimate payments you're making. It may be an opportunity to take a look at the self-employment taxes that you're paying, if you may need to structure things differently. So for me, that's what I tell clients is basically step one, is just take a high-level look at the return, see what your effective tax rate is, how much tax did you pay throughout the year, and then let's have a conversation over kind of maybe things were higher this year, why was that the case, why were things lower, what are some different strategies we can take, things like that. But that's usually the first step.
That's a cool little rule of thumb, like something easy somebody can do, right? I mean, you can look at your total, like you said, the equation is look at the total tax number that you're paying, and then divide that by the adjusted gross income, which now I'm not a tax preparer. Well, that's a certain line in the tax return, obviously.
Yes.
And that's going to give you the effective tax rate. So I get it, though. A lot of people, make a big deal about tax brackets and how much tax I'm paying. But actually taking that look and doing that equation, find out, all right, my effective tax rate is this, and then the second step, I think you're saying, is, all right, then let's examine what are some of the things we can do, well, during the current year for the following tax year, over the current tax years, maybe to improve my situation, maybe do things a little bit differently to improve my scenario.
Yeah, exactly. So what I do for my wife and I personally is I do that. That's the first thing I do is what was our effective tax rate for the year? That should be, if you're looking to kind of net things out towards zero in April, that should be your withholding percentage.
Gotcha.
Then it's sort of understanding, okay, what are our large deductions that we take advantage of? Are we going to have these in the next year, in the next 5 years? Sometimes yes, sometimes no. If you have young kids, maybe they're getting to an age where they're not going to be your dependents anymore. Or, if you're taking the itemized deduction, what's that being driven by? For me, a lot of it's real estate taxes and mortgage interest. Hopefully in the next 10 years, that's going to go down. And so we need to kind of plan for that, what that change is going to be. Same thing for anyone who's self-employed. Income can fluctuate. So as it fluctuates, you just want to make sure that you're making the necessary estimated tax payments. But also, what are your deductions for your business? Sometimes there are large capital deductions, and you've taken accelerated depreciation, and that can change year over year depending on the tax law. Other times you have other expenses throughout the business, and it's sort of just getting a grasp of, are we going to have this next year? Are we going to have more next year? And just getting that basic understanding.
Yeah, no, that's super important. And one thing that makes me think about is when we talk about all of the different deductions and looking at your tax return, it's not always a bad thing that you owe tax necessarily, right? Because one of the things you and I have talked about, and the thing that I have done in my own personal financial life is I try to put as much money into the Roth side of the equation that I possibly can. Now, what that means is, and just to give a little educational piece for those that might be confused on what a Roth is or the differences, but essentially the Roth IRA allows you to put away, or the Roth 401k allows you to put away money that you've already been taxed on, so that grows over time, and when you go to take a withdrawal after your retirement age, it comes out tax-free. But you don't get any tax break up front, right?
Correct.
And so that technically can create a higher tax bill for you than would have happened if you were to have done a traditional IRA or a traditional 401k contribution. And so that's something that you and I talk about. I think we're both on kind of the same side of the table, no pun intended, about hey, look, like, it's hard to look down the road too far and understand, hey, what a tax rate's going to be, later in life. But it just seems like such a great benefit when you look at the ability to, okay, take the tax bite right now, and then that money's been taxed, not going to be taxed again. Let that compound and grow and grow and grow, essentially forever.
Yes.
At least in terms of your long term. So tell me more about that.
Yeah, for those who aren't aware, the Roth, in my opinion, is the best tax vehicle there is by far. So like you said, the difference between a Roth and a traditional IRA is when you get the deduction. So if you put in $7,000 this year to a traditional IRA, you can deduct it. You can't for the Roth. However, the Roth grows tax-free. So the question I typically pose to clients is, would you rather be taxed 33% on $100,000 or 33% on $1 million? That's sort of the big question.
I like the way you broke that down, yeah.
Because for an IRA, yes, you get the deduction today, but that is going to grow and grow and grow, and you're going to be taxed on it, not when you distribute it, and also when you get to a certain age. You get into required minimum distributions, and where you're essentially forced to take distributions year after year. It can phase out deductions. It can get your income levels much higher than what you want to be showing when you're retired. The Roth is, once it's in there and it's protected, and it can grow, and it's tax-free. You can distribute it whenever you want. It's way easier, way cleaner for estate planning, giving it to your children and your grandchildren. It's a really, really effective tool, but to your point, the trade-off is, you're biting the bullet now.
Yeah, it almost feels like a loss, right? It's like, oh, I don't want to, if I have the opportunity to take a deduction now on money that I'm not going to touch right now, why wouldn't I take that tax deduction? But I love the way you said that. It's like, well, look, $100,000 today, would you rather have a tax deduction of 30% of $100,000 today, or 30% deduction on a much higher amount of money, hopefully, 20 or 30 years from now?
Yeah.
Possibly.
And even if you're a client who's older and maybe you're in the RMD world right now, it's still, I think, beneficial to make that conversion over to a Roth. And one thing that I think people get confused on sometimes when they start to think about this is there's the contribution amount limit, which can vary, but it's restrictive. And then there's the rollover limit. So if you have a huge balance in an IRA, there's no limit to how much you can roll over into a Roth.
Right.
So the tricky part is for taxpayers is getting that money into either the IRA or the Roth structure year after year, because you need to chip away at it.
Sure.
Another reason why it's great to start young. But if you're in a situation where you have a huge balance in a traditional IRA and you want to roll that over, you can do that. There's no limitation on that. There's no income limit, no dollar amount that gets cut off. So, but even if you're in that position, let's say you have a nice portfolio that you've worked really hard to build, it's in the IRA, you can roll that forward into a Roth. You're going to pay taxes on it, but you can have it withheld at the time of conversion. And then it's in there for good, and then it's going to grow, and you're never going to pay taxes on it again.
Right.
My gold standard, like I like to say, for someone who's built a nice portfolio of wealth and they're retired, is I'm filing the tax return at the end of the year, and it almost looks like you have nothing to your name. You get some Social Security benefits, maybe a little pension income, and that's about it.
Right.
And as far as the IRS is concerned, from a tax perspective, you're getting all these deductions. You're not phased out of anything. Your IRMA premiums are low. If you are doing things for Medicaid or home health or whatever, a lot of times that is based off of your adjusted gross income.
Right.
Which is low because all of your wealth is in a Roth, which does not show up at all. Where if it's in a traditional IRA, you may be taking RMDs of X amount of dollars, and then it kind of...
And that's driving your income higher, which in turn is what you're saying, that's driving the ultimate cost of all these things, from Medicare and all those things. You mentioned IRMA, so...
Exactly. Your Medicare premiums, if you need home health, it's like they take a look at that, and some of your other deductions, your standardized deduction, medical payments, if you're itemizing, all these things get phased out and they're harder to deduct the higher your income levels are. So again, like the gold standard is a client has almost all of their wealth in a Roth structure. So when they go to file their tax return, they're able to take full advantage of all these deductions.
That's fantastic. Yeah, and it's interesting too, and I know we're going to talk about it a little bit later, but the things that you're talking about have a lot to do with tax planning, right? And in putting the pieces in place throughout the year, having these conversations, which it can be tough to do when you have different professionals that are not underneath the same roof. But we'll get to that a little bit later. But one of the things that unfortunately always comes up around tax time and is this element of surprise. And I've experienced it myself personally over the years, and certainly talked to clients about it often. And I'm convinced that it's not so much that folks get upset, or myself, about having to pay tax, although none of us, I think, want to pay any money to the government that we don't have to, we shouldn't have to. But it's a whole different ballgame when it's not so much they have to pay the tax, but they didn't know that the expectation wasn't set, and they have professionals in place, and it's a huge surprise. So it's the surprise part of things that really is the negative part, to be able to do things and plan before then, so that one, certainly we can limit as much as we can from having to pay tax, but two, to know that, all right, I know that I'm going to have to pay something around X by the time April 15th rolls around. So I want to make sure all these different things are in place so that this is either paid in quarterlies throughout the year, or just that I know that I'm going to have to set money aside. So what's an example coming out of tax season now where there has been a big surprise? And can you tell me a little bit about that?
Yeah, sure. It certainly happens. It even happened for me. This is the best time of year to sort of understand where things lie and to make adjustments, whether it's, you're adjusting your withholding or you're just, again, taking a high level look at your tax return. But even for me, I went to go file my taxes and I was expecting a refund of a certain dollar amount. And I go to prepare my return and I take a look at my W-2 from a previous employer, and I noticed that I just was under withholding from what I typically do. So I knew right off the bat, before I even entered it into the software, I said, oh, this is not going to be what I was hoping for. So it's kind of just taking a look at what's driving the surprise. And it's also a great time of year to check in with your tax advisor just to make sure that everything looks good, that my withholdings look good, or everything that I'm expecting for now 2026 is going to put me in a position where if I do owe a lot of taxes, I'm aware of it and I know it now, or that I'm not in that position. And again, it's, I think, a little bit less of what do I owe and what's my refund, and a little bit more of what's my overall tax bill going to look like. But to your point, it's much better to know it now than towards the end of mid-April. And all of a sudden it's, oh man, I got to scramble.
Yeah. Well, I'll tell you, I appreciate the personal story because it happens to the best of us. I can think of years ago where one of the strategies that we run at Beck Bode is for a handful of clients is an option strategy. So the growth strategy that they're involved in, very disciplined, very ordered strategies, as you know about. We also, for a select group of clients, for a small part of their portfolio, and including something that I do manage for myself as well, is an option strategy. So we buy options on the stocks that we've identified in the growth strategy. So happen to have a really, really good year in the option strategy that year. And options we typically buy at 6-month intervals. And so when those come due or we sell them, they're ordinary income. They're not long-term capital gains, right? And that was something that, in the midst of me, working with clients and so on, I didn't really pay much attention to in my own personal taxes to plan for and understand, hey, this huge gain that I made was going to be taxed by ordinary income tax rate and not at the smaller long-term capital gains. So come the beginning of the year, or the spring, I got a little surprised that I owed a lot more money in taxes than I had kind of planned for in my brain. So I guess the message is don't beat yourself up too much. That it happens to the best of us. But certainly over the years, understanding how important tax planning is. When we're having our regular reviews with clients, the conversations about tax are a lot more in the picture now with you aboard and building out our tax services. And that's a large step forward in certainly eliminating or mitigating surprises, but also just preparing folks for the best or most optimal tax scenario for them.
Yeah, absolutely. And it can go both ways too. There are times that, me personally, it's like I go to file my return and we have a really large refund, and it's great.
I've never had that.
It's.
Why do you tease me? Yeah,
I know.
I want that. I want the refund.
And it's great, and you're like sigh of relief. But then at the same time, you kind of ask yourself, okay, well then why did I withhold so much? Maybe I can change my withholdings. Is this because, again, and it's taking a look at what's driving it, and you say, all right, well, why did I have such a large refund this year? Oh, it's because now I have this large deduction that we're going to have for the next 10 years, whatever it may be. Now I can maybe adjust my withholding. So now I'm getting more in my paycheck biweekly. And it's a little bit better than kind of essentially giving the government an interest-free loan, which a lot of people have an issue with, understandably.
Yeah.
So, it can go both ways, but Yeah, it's great, I think, having the tax and the investment in-house, and because the two things really do go so well together, and it makes it a lot easier as a tax accountant to have clients in-house where we can kind of take a look at things, from the big picture, rather than, being at a CPA firm, and a lot of times it's crunch time and you get a lot of information all at once and you put it into the return and that's it.
Yeah, and then it turns into, a lot of times, sort of when you're trying to coordinate things amongst professionals, it turns into the game of telephone, right? And things get missed, or you run the risk of, like, sometimes some very important things to get missed when you've got professionals in different places. And again, the reason why someone has a tax advisor and has a financial advisor is that they feel there's a lot of value in having a trained professional do and implement something that they don't feel confident doing themselves, obviously, right? But when those professionals aren't in an optimal place to be talking to each other, and they both understand, or they all understand exactly all the circumstances, then things get missed, right?
Yeah, and everything, tax and investments go hand in hand. So, in this scenario, you could come to me and say, hey, we just did awesome with our options, and we have these clients who are probably going to have a large gain. It's so easy for me now to reach out to those clients and have a conversation and just say really quickly, this is what you should maybe expect to be paying in taxes this year. And you can pay it, right now to get ahead of it, or not, but just be aware that this is what it's going to look like. It's also so optimal to be looking at it from the big picture of somebody who is gearing up towards retirement, and where are your funds? How are they structured? And how is it going to affect you from a tax perspective? Same with legacy planning. I think one of the advantages to having it in-house here at Beck Bode is having those two functions work together. I just know from my experience at CPA firms, a lot of times what happens is all the information comes in at once. You get all the tax documents in February and March and April, and you're working hard to crank out the returns, but what you're focused on is just making sure that the return is done accurately and that the client is aware of what they owe or what the refund may be, and then you move on. And maybe you have a quick conversation in the fall or something like that. But there's really not a holistic approach.
Yeah.
You're getting the 1099s from the brokerage accounts, and you're plugging it into the software and you're filing the return. You're never really taking a look at what kind of account is this. I wonder how much money they have in a Roth. Like, there's really no connection.
Are there opportunities to optimize things for them, right? These little things that, and I can imagine, certainly, because I've experienced it before personally, like years ago, is that when it comes to taxes in the IRS, there's a little bit, from a client standpoint, a little bit of an overwhelming feeling of not wanting to screw things up, right? Because it's the government, right? And there's also, again, going back to the concept of it being a game of telephone, is that this is not just like investments. I often talk about with when I sit down with folks, I think we've had this conversation before, it's like we try to keep it as simple as possible, and that's why our investment strategies on the surface are very simple to understand. It's because the investment industry out there I liken to a super Walmart of choices, right? And it can be so overwhelming of all the different ways that you could potentially invest your money, from stocks, bonds, mutual funds, ETFs, Bitcoin, real estate, all these different things. And then the question is, well, how do I best optimize my money? And then there are tax implications to these different types of it. So the idea that as a consumer, that you can meet with a professional, let's assume that they're not all under one roof, but you meet with a professional, and then be able to go, if it's a meeting with a CPA, and then be able to go to your investment advisor, your financial advisor, and recount all the things that you might have talked about with your tax advisor, or vice versa, something is going to be lost along the way, right? And unfortunately, that's how it works with a lot of folks. But on the concept of like the super Walmart, analogy, there's so many things I think that people don't understand that can. And what's one thing that you wish that people knew or understood about where their money sits or their money can sit?
Yeah, I think I wish more people sort of took a look at where their money sits, how it affects them from a tax perspective this year, but more importantly, how it affects them 10 years, 20, 30 years from now.
Yeah. So the Roth is an example of that you just covered, right?
Yeah, it's a great example. Another is, if you have a lot of money that's just in a brokerage, kind of understanding the tax implications of that. If you're doing short-term trading, it's going to be taxed at ordinary rates. If you're holding for more than a year, it's long-term and it's long-term capital gains. But a lot of times, going back to the surprise tax bill, a lot of it is driven from that, where people have really good years in a brokerage, but they're not necessarily seeing it because the money is still in the brokerage.
Right.
So all of a sudden, we did great with options or short-term trading.
Right.
And yes, my account value grew, but I actually wasn't expecting this huge tax bill this year. So I think that's kind of what I wish for every client, is really that they are able to kind of take the higher look at, okay, what's my activity? What's my investment activity? What are my retirement goals and things like that? But what's the tax implication of all of it? But the really nice part of having everything in-house is just that, having the two pieces communicating together.
Yeah.
For a lot of our clients now, when I go in and prepare their return, I'll review it and just do basically what we've been talking about, is before having that conversation with the client, sort of understand where were they last year, where are they this year, and kind of where are they going to be next year. And the nice part for me is I can take a look at our systems and just see where is everything parked for them. How much do they have in a brokerage or an IRA or Roth? What are they looking to do? Like, are we starting to think about legacy planning and things like that?
Right.
It's a great opportunity just to take a look at the big picture.
Yeah, the word you used there before, which again can certainly be a buzzword on industry, but it's a really important one. But you said holistic, and that's a really really good point about all of this, is that your ability now in-house to be able to understand, being part of meetings with us, with clients, but being able to very easily look at, okay, what did their situation look like last year in their investment accounts? Hey Ben, for so-and-so, Mr. and Mrs. Jones, the client, have you had the conversation about the Roth this year? Because their income's really low. All these different circumstances that, I don't know. I don't get calls from outside CPAs. I don't much ever about, hey, can you take a look at, my client's account and see if there are opportunities to do X?
Yeah.
I've been doing this for 20 plus years. I don't get those calls, and we talk to clients about, hey, look, I'd really love to coordinate. But to your point is, when tax season rolls around at your traditional CPA firm, there are some great CPA firms out there, it is very much go time, right? And if the planning isn't done along the way and taking those opportunities, like you said, like you have the ability, hey, I can just go in and check, and see how things are going. Things can get lost. So yeah, the main point of this discussion today is what we really wanted to get to, is what this reality now of having all of this under one roof with our clients, be able to offer them what we think is a truly an optimal service for their future. So one of the things that I wanted to ask you, considering that you have experience with more traditional CPA firms and different firms within accounting, what's different here?
I would say the closeness to clients is different. When you're at a big CPA firm, you have a huge list of clients and a huge hierarchy as well of who prepares the return and reviews the return and sends it out. It's more like a machine. And it, I think, needs to be that way for a lot of the bigger CPA firms. But what's nice about Beck Bode is that it's got the smaller feel where I understand a lot more what's going on with the clients than I ever did at a CPA firm. You know, being at a firm, it kind of puts the client in this sort of like middleman position where if they want to optimize their situation, they need to sort of reach out to their CPA and say, what's driving my tax bill? And then they'll say, could be X, Y, or Z. And then they now need to go back to their investment advisor and say, how can we optimize this? And it kind of, you know,
right. That game of telephone shows its face again, right? It's that because, you know, tax returns can be complicated, right? Especially to folks, even, you know, to folks that even have a little bit of knowledge about how the tax preparation works, right? And so this idea that you can get information from your CPA and then be able to somehow not translate, but recount that same information back to your investment advisor, or vice versa, in a lot of ways too, when neither, you know, party knows exactly what's going on the other side. That's a really difficult. I feel like that's a really difficult proposition. And I'm not saying that because of my experience. I'm saying that just in you know, over and over again, having conversations with folks and understanding that, hey, look, they are busy with their own lives and their own work and their families and everything. And the idea that they have to be the ones translating information back and forth, that's just a tall order.
Yeah, and it's just one of those things.
It's unnecessary.
And it's one of those things that I think just doesn't happen. You know, I think it's too difficult. I think also, you know, CPA firms typically have their different seasons outside of busy season, right? So they do their business returns up until March 15th, and then they do their individual returns. And then depending on the size of the firm, maybe they're auditing pension plans in the summer and things like that. So things are always moving and constant. So it's just much more difficult when you're at a CPA firm to take a look at things holistically. And you know, what I have the ability to do now is to review things at the end and then maybe now say to you, say, hey, you know, this person really got hit with some good capital gains taxes or ordinary income taxes with the short-term stuff. Like maybe we could do those trades inside of an IRA or a Roth and protect the client, or whatever it may be. Is sort of just working together is a lot easier, and it gives me personally an opportunity to kind of see things and understand things in a way that I wouldn't have been able to before.
Well, I got to say, you know, from my own perspective, you know, working with you has been fantastic. You know, to have as you know, you've been in numerous meetings together with me and with clients, and so not only do I get that extra level of understanding about, hey, what's going on in their account, now they feel really good about knowing that, hey, you know I talked to Ben throughout the year, but now I'm talking to Garrett throughout the year too, together, and that I really feel like there's a solid team around them. And that's just firsthand feedback that I've gotten from clients about that, and that drives more confidence for them in terms of the decisions they make along the way, to know, hey, look, the people I have now at my fingertips, my team, know and are working in concert with, you know, our financial circumstances. And I know in my own personal life, like in other areas of my life, I like to work with people that take an interest in what I'm doing holistically in my life, and that know me and can give recommendations and so on. So that's what we, you know, endeavor to create here, you know, as we build this out with you. And we're already seeing now at the close of this tax year, we're already seeing just some huge positive feedback coming out of it.
Yeah, and it's what I really enjoy too. It's so much nicer having that relationship with the client and just understanding what they're doing and where they're going. It makes my job a lot easier and more rewarding. And then we can kind of focus on the strategy and the opportunities, and a little bit less on kind of catching up and here's the information I need, and you know, people are getting surprised, things like that. Now I understand the full picture. And so, you know, how are we going to get there in the most tax efficient way? that's a lot more exciting to me than just
Yeah.
cranking out returns and handing it to someone else for review and then on to the next, et cetera.
Absolutely. No, this has been, I've really enjoyed this conversation with you today, and I think that excited about the future too. It's going to be fantastic. Our clients are going to benefit from it. Future clients are going to benefit from it. Speaking of clients and folks, we do have a few questions that folks have sent over to us that I'd love for you to give your thoughts on. One was the biggest mistake that you see with 401k contributions.
Yeah, I don't know if there's necessarily many mistakes with contributions, but I think, again, it's kind of understanding how you're diversified, right? And that's huge in your world, I'm sure, is diversifying your investments. It's also big in the tax world. And again, it goes back to the Roth structure versus the traditional structure. Also, for many self-employed clients, are you maximizing your contribution limits? If you're a W-2 employee or maybe you're a retiree, it's a little bit more straightforward as far as how much you can contribute. If you're self-employed, it's maybe we set you up in an S corp. And do you have a 401k plan? Do you want to contribute to a traditional or to a Roth, and are you diversified? So there's a lot of moving parts. So I don't know if there are many glaring mistakes you can make with a 401k or an IRA, but I think there's a lot of opportunity that's lost if you're not kind of having that conversation.
Well, I was just going to say that. I was just going to say that because hearing you kind of rattle off a few of these examples of things that folks are facing. Again, I can imagine this overwhelming feeling of being a business owner. Well, I'm a business owner. I know owning a business can sometimes be a little bit overwhelming. But just in general, I mean, some of the things you said is like, okay, well, I've heard of this S corp before. I've heard about these different things. Should I do them? Should I not do them? And not really having the resource to kind of bounce these on, in this now feeling of I got to figure this out myself and what the most optimal thing to do. Okay, certainly you can go to a CPA and talk about those things, but now, under our roof, you have, not only the really qualified tax preparation and planning, but in an environment where your entire financial picture sits, with your investments and everything, that just creates, like you said, a great opportunity for a conversation where, hey, let's talk about, all these things because we know about them all, and we'll help you build the optimal structure for you.
Yes. Yeah, and it all goes hand in hand, really. It's, are you sheltering yourself from some self-employment taxes? Are you doing payroll? We do that for many clients. And what's your income look like for this year? And how much do you want to withhold from payroll so you're not getting hit with a surprise bill at the end of the year?
Right.
What does that mean for your 401k contributions? It all gets tied together, and it's just so helpful to have all of it under one roof where you're kind of managing the entire process rather than getting on the phone with your CPA, and sometimes they may help you out with it, sometimes they may just have a conversation with you and point you in a different direction. So it's nice to have it all in there together.
Yeah, so not necessarily tax related, but one of the big conversations I have with many, many people when it comes to the 401k contributions and just the 401k in general is that a lot of people just default to this nasty little thing inside the 401k, which is called a target date fund. So the target date funds, for those of you that don't know, are like predetermined age-based investments where each year that goes by in your life, they technically get more and more conservative. So your allocations towards equities as you get older goes down, and your allocation towards bonds, no bonds, goes up, which is a huge, huge no-no. The biggest reason for that is over time, the real return of long-term equities is about 7% versus 3% per year versus bonds. So you're basically giving up more than half of your return on a real basis by doing this. And one argument to that is sometimes, well, I'm getting close to retirement, so shouldn't I be a lot more conservative? Well, most folks are retiring. One of the spouses now is going to live into their 90s. So most folks are looking at a 3-decade, maybe even a 4-decade-long retirement. Not a point when you're 50 or 60 years old where you should be getting tremendously conservative, but that's exactly what these funds do. So didn't want to move the conversation away from tax, but I wanted to mention that. Another question, just got a refund. What's the smartest thing to do with it?
That's a tricky question. I think it sort of depends on where you're at and what you want to do with it and what the refund is.
Yeah, it's kind of hard to answer that in a one-size-fits-all, but...
Yeah, I mean, one thing that you can do, I think that not a lot of people are aware of, is when you're going to file and say it's April 14th, and we come to you and you say, you actually, you have a $20,000 refund. What we can do is click a button and it's now being treated as an estimate payment for next year. So that's one option that I think a lot of people are not aware of, and it kind of can save a few steps. If you don't want to invest it, you don't want to put it towards something else, you want to put it towards taxes, boom, it's an estimate payment. So next year you can adjust your withholdings, you can skip an estimate payment if you want, depending on the situation.
What about a nice trip to Aruba?
That's a great one too.
Because I like those. Yeah. I've heard that place is really nice.
That's where I went on my honeymoon.
Oh,
great place.
Oh, really?
Yes.
Oh, we got to talk about that.
Yeah.
That's it. Yeah. So, last question: what has changed in the tax code this year? Anything notable that's changed that maybe a fair amount of people don't know about?
Yeah. So the One Big Beautiful Bill, which went into effect for the 2025 tax year. So by now, everyone is a little bit more familiar with it because they've filed through it.
Just because it's fun to say, too. Big, beautiful bill.
One big, beautiful bill. Yep. There are a few changes. I think one of the changes that affects people largely is it's called the SALT increase. And that was a big change in 2017 under the Tax Cuts and Jobs Act, which reduced it and it capped it at $10,000. What SALT stands for is state and local taxes. So depending on the state that you live in, it may affect you more than other states, the high tax states. So it could be, it's a combination of your state income taxes and your real estate taxes and some excise taxes. It comes into effect if you are somebody who typically will itemize deductions if you have mortgage interest and things like that, where now it's being capped at $40,000 rather than $10,000.
So in a real life scenario, so that people understand, so for example, in a potentially in a area, Massachusetts or California or New York, where real estate values are really high, and yes, but also like real estate tax is really high. Prior to that, that was capped at $10,000. Is that right?
Correct.
Okay.
Yeah. So if you're itemizing and you're deducting your SALT taxes, it was capped at $10,000. Now it's capped at $40,000. So for a lot of people, that's a big change.
Huge change, yeah.
And it's income taxes and it's real estate taxes. So what's interesting is, in some cases, it even affects New Hampshire residents who pay no income tax, but they have higher than average real estate taxes. That's typically how New Hampshire kind of makes up for it. It still affects them. So it's a nice added deduction and a big change from the 2017 tax bill that was most recently in effect.
Fantastic. Fantastic. Well,
another big one, if I can mention really quick, is the accelerated depreciation of Section 179 and bonus. So might generate a conversation with us or your tax advisor, especially if you're self-employed, but that is a really beneficial feature of the One Big Beautiful Bill. Something that was around before, it got phased out, and now it's back. But what it does in a nutshell is if you have a large investment for your business, you can now write it off, in most cases, 100% in 1 year. So, if you buy a truck and it's a business truck that you use 100% for business, you can write it all off in 1 year. So that really will move the needle. And again, I think to bring it full circle, that's another thing that should be understood and analyzed when you're done filing your tax return, because I can actually think of a couple clients who utilized it in 2025 where they bought a new vehicle. They were able to take Section 179 and deduct the entire thing this year. But one thing that they'll need to be aware of for 2026 is now you don't have that deduction. So now that's being not taken away, but it's not available.
Right.
So it's going to be a big change.
Right. Yeah.
So
Gotcha. No, that's important to understand. And not only, I don't think the takeaway is it's something that is for everyone, but it's something that that is brought back with a big, beautiful bill, right? And so that it's available out there. And again, it just it underscores again the need to have a conversation about, hey, how can I optimize and make all of these changes most beneficial if they can be in my financial life.
Yeah, the tax law is extremely dynamic, and the economy is dynamic, and the stock market and all these investments. So I think it's always worth having a quick conversation with your tax advisor just to better understand all of the implications.
Well, I got to say, as we wrap up here, I'm really impressed. Congratulations, and I'm congratulating you for somebody like me. You made a tax conversation really interesting. So
I'm glad. Thank you.
So I think that is important. And again, as we talked about, throughout the episode today, I think we're both really excited. You coming off your first tax year with us, and your feedback has been fantastic. We've gotten a lot of great feedback from clients about the experience and their confidence level rising. Really looking forward, Jim and I, as the owners of the firm, really looking forward of expanding our tax practice within here. I just think it is so incredibly beneficial to our clients to be having that conversation sort of all in one room with you and us, and that feeling of knowing that, hey, we're not missing anything on the tax side, and the opportunity to have tax-related conversations with your financial advisors present is just such, in my opinion, and I'm a consumer too, is just such a huge, huge benefit. So I really appreciate you coming on today. This is your first No Bonds cast.
First one.
Look forward to doing more with you in the future, and I hope everybody got a lot out of today's episode, and looking forward to doing more. So thank you, everybody.
Thank you.